FBN Holdings Plc, Nigeria's leading diversified financial services group, today engage market stakeholders on its financials through the forum Facts Behind the Figures at the Nigeria Stock Exchange. Giving the opening remarks, the CEO of the Nigeria Stock Exchange, Mr. Oscar Onyema, commended the management of FBN Holdings Plc for the timely visit to the market, giving relevant information, thereby promoting transparency.
2016 was a year characterized by significant uncertainty in the operating environment. Despite this, FBN Holdings has delivered a solid performance. This performance has been achieved through ongoing initiatives in driving efficiency across the various businesses, transforming the risk management containing costs, as well as enhancing revenue generation from the banking and non-banking subsidiaries. It gives me great pleasure to know that the group recorded a strong financial performance, making good strides on the initiatives instituted across its businesses. The exchange will continue to provide a platform to support listed companies to meet their strategic business objectives. We will continue to position ourselves as the African exchange of choice for African issuers and global investors by implementing far-reaching transformational policies aimed at strengthening the corporate governance of our listed companies and providing products that are aligned to investors' requirements, whilst also ensuring a fair and orderly market. With the fast-changing macroeconomic environment in Nigeria and globally, we encourage FBN Holdings to continue to build on its culture of excellence, innovation, leadership, customer service, and professionalism towards attaining a deeper social impact, higher regulatory compliance, and greater returns for shareholders.
Mr. UK, the Group Managing Director of FBN Holdings Plc, in his presentation, gave insight into the critical issues in the whole coast market performance and strategies in place.
At the time we made the commitment, these were the facts on ground. If you check the Q1, we had rising inflation from Q1 to Q2, and the question was, how could you, in the face of rising inflation, make commitments on cost reduction? And how could you deliver on your NIMs? Guidance of 8 to 8.5. Of course, we saw that by the end of 2016, inflation had gone to 18.6% thereabout. Currency. In 2016, we saw an effective 100% deval of the currency. If you check what happened, the red block there in Q2, we saw the currency depreciate to a high level. Again, further raising concerns on the capital of the bank. And so this was the environment under which we operated, and we still did not revise our projections. Despite the challenges we went through, we know that the business remains fundamentally strong, which is why we use the word resilient in describing our performance for 2016. And despite the fact of rising inflation, the fact of devaluation that occurred, taking the currency to over 360, in fact, at some point, nearly 500 for last year, despite the fact that we took a decision to accelerate provisioning, which led us to taking a hit on the P&L of 226 billion, something that had never happened before, coming after 119 billion we took in 2015. Despite all of that, we recorded very significant improvements in our numbers. Total assets, loans and advances, customer deposits, total equity, we saw growth. Now, I think the more important slide to look at is this, the key ratios. Talking about the solvency ratio, talking about the liquidity ratio, and of course the efficiency ratios. How could we have achieved a cost-to-income ratio of 47.1%, coming down from 66.1% prior year, in the face of rising inflation? How could we have achieved that cost-to-income ratio when service providers had factored in devaluation even at 500 naira levels in the services provided to us? How could we have achieved a cost-to-income ratio of 47.1% when PMS moved from 90 naira to about 120 naira, and diesel moved from 145 naira per litre to over 200? 850 business locations, in some cases 2 generators. We had to take a deliberate effort on the part of management to be efficient, and we delivered the numbers. But these are the facts. If you look at the capital, we delivered. The concern was how would they be able to maintain capital at above CBN level. But we closed 2016 at 17.8 at the commercial bank. In fact, at the merchant bank, it was about 25%. And then for Q1, we've gone to 18.1% at the commercial bank. And so across these various metrics, you will see a bank that has delivered, a group that has delivered. I think that the major issue that impacted our numbers was just the loan loss provision that we took in 2016. If you back that out, this bank was the best performing commercial bank, indeed, group in the industry. Indeed, I can confirm to you that during this period of 3-year cycle, which ends 2019, by end of 2017, our NPL ratio will be less than 20%. I can confirm that by end of 2019, our planning cycle ends at that time, our NPL ratio will definitely be lower single digit. And the cost of risk will be anything between 1 and 1.5%. That is what we are committing to. NPL single digits, it will happen in our planning cycle to end in 2019. Cost of risk less than 2%, that will happen, we'll commit to that. Cost to income ratio less than or equal to 50%, that will happen. Enhanced revenue generation, collaboration and synergy across the various operating entities. Return on equity, we believe that when we conclude our process reforms, we'll begin to see ROE north of 20%. And of course, dividend distribution. Let me spend a second to talk about this. In the last 2 years, the commercial bank has not upstreamed dividend to the holding company, and it was deliberate. It was part of the measures we took to recapitalize the commercial bank through earnings retention. And so if you add back the 50 billion that was made by the commercial bank last year, that could have easily given us nearly 60 billion distribution to the shareholders. And the 50 billion would have accounted for, or would have resulted in about 1 naira 40 kobo thereabout in the dividend. What that tells you is that by the time we finish and get the commercial bank to begin to upstream dividend to us, then the capacity of the holding company to distribute dividend will be enhanced. So you can do your projection, assuming that, okay, the bank has cleaned up 2018, where will the dividend per share be? What impact will it have on the shares? And so if you are taking a position, you need to factor that. It's not about today, it's about what we are doing to clean the books so that we can have a very clean franchise that will have unlimited capacity to pay dividend and share price will appreciate.
Mr. Eke speaks further on the situation around the 20 to 25% non-performing loan status and the digital banking strategy of the Financial Services Group.
I think the facts on ground which the market accepts is that there was indeed a concentration of the NPL, and accounting for, 6 obligors essentially. And to the extent that we have mapped the universe and we are dealing with the resolution, like I said, we are at different levels of resolution. We do believe that from the commitments made and the efforts that have been made already and the results we are seeing, clearly we are going to see a drop in the NPL below 20% in 2017. And we are saying that to the extent that we've already agreed with those obligors on how to resolve the outstandings, if you stretch it within the planning cycle, which ends in 2019, we're optimistic that the loan book will be a lot better. So we are confident that the NPL would be single digit, certainly around about 5% in 2019. But more importantly, the cost of risk will also trend downwards, and we think that we can achieve about 1.5% cost of risk in 2019.
Finally, there's a great shift by banking services to e-business, and you know that first FBN Holdings has a big stake there. What's the strategy to ensure that you are the key player despite the huge competition, and how you leveraging on it?
So first, we acknowledge that we are the market leaders in terms of customer account and the retail space. We've got about 13 million customers, and the plan is to double that in the next 3 years. You can only do it through the digital play, clearly. And so we are investing in technology. Of course, we are also counting on the initiatives around cost efficiency and then creating convenience, particularly the USSD banking, where in just about 6 months, we've activated about 1 million customers. Our plan is that within the next 2-3 years, we'll have activated nearly 5 million customers on just the digital platform. And then they begin to transact with their mobile phones. Now, these are not phones that are sophisticated, just the USSD banking alone. Even with a dumb phone, you can do it. So our belief is that from the reforms we have undertaken and the investments we are making in technology and the migration of customers away from the bricks and mortar to the digital platforms, we will be able to attain market leadership in digital banking in the next 2 years.
With the report of a no fresh non-performing loan case and the plan to reduce the current level of non-performing loans below 20% beginning from 2017 to 2019, FBN Holdings Plc is certainly on the path to sustainability, which will translate to value creation to customers and profitability to shareholders.